So good morning, everyone, and welcome to a new session of Chamber Talk. For those of you who are joining us for the first time, this is Sultan Hatoum from Abu Dhabi Chamber of Commerce and Industry. This is our 16th session. This is our 16th session of the program, and we are hosting with us today a panel from Deloitte and Clyde Co to discuss a very interesting topic, which we believe is critical to address and highlight at these exceptional times. We are talking about fast-track M&A. So this is our third webinar with Deloitte, where we have covered in our previous two webinars, crisis management and key considerations of getting back to business, and liquidity solutions, how optimal cash and working capital management can improve liquidity. If you couldn't join us on these sessions or have missed any of our previous 15 webinars, I would recommend that you visit the Chamber's YouTube channel, where we have made them all available for you to watch at your convenience, and leverage all the insights basically provided on different topics by the expert speakers we've hosted from all the Big Four, Gartner, and Solomon partners. I would like to remind you as well that we are running a parallel session with instant Arabic translation. Shall you wish to listen to the session in Arabic, you can access it via the link that the team just shared in the chat box. As usual, we're going to have the last 50 minutes of the session for Q&A. So please engage with us by submitting your questions in the Q&A box, and the panel will try to address as much as possible of it during the end of the session. Given the nature of the topic, we thought that for today's session, it would be more engaging if we have it in an open discussion format with the panel, where Ali from Deloitte is going to join me to co-moderate the session. I'm not going to talk about the topic in the intro for the first time, as I leave it to the discussion with the panel and, of course, to keep you excited. So please allow me to jump directly to introducing our panel for the day. I will start with Deloitte's team. We have with us Sam Surrey, a partner in Deloitte's Middle East Financial Advisory and leads the Transaction Services Education Sector team. Sam has specialized in transaction services for 17 years, and prior to joining Deloitte, he was a partner with BDO in the UK and Dubai. Ali is an assistant director at Deloitte Middle East Financial Advisory team. He has more than 11 years of professional experience in financial advisory and audit. He supported clients through different types of transactions, including financial due diligence and SPA support, business planning and performance improvement, and value creation services. From Clyde & Co, we have Stephen McKenna, a partner and corporate lawyer who has been working in the MENA region since 2009. Stephen's practice primarily focuses on M&A, joint ventures, business and asset purchases, FDI, commercial contracts, and corporate structuring. Stephen advises a wide range of clients, including SMEs, public and private companies, as well as government and government-related entities, both regionally and internationally. Our second speaker from Clyde & Co, Rashanak. Rashanak is an M&A and corporate lawyer in private and public sector and has been working for almost a decade in the Milan and London offices of a leading Italian law firm. So I'm gonna start right away with the topic for the day. And Sam, the question goes to you. So what is generally meant by fast-track M&A?
Thanks, Sultan. It's a pleasure to be with you this morning. Yeah, fast-track M&A, it's a phrase we're hearing increasingly at the moment. And why is that? What does it really mean? Well, look, as the name implies, it's about getting an M&A transaction done quickly and more quickly than might be the normal course of events. So the question is, why would there be that desire to consummate a transaction quickly? Normally, M&A transactions can be measured in months, and there's a good reason for that. From the buyer's perspective, it's important to do full due diligence, to try and understand as much about the business you're investing in as possible. And that takes time to get to know that business, even if you're in the same industry or perhaps even have a relationship with the business. So you want to understand the financial history of the business, you want to understand the projections, you obviously want to understand from a legal perspective what issues there might be. You want to get an SPA that's well structured. All of this takes time from the buyer's perspective, and there's no particular reason to rush it. From the seller side as well, whilst the seller wants to make sure a transaction gets done relatively quickly, they also want to make sure that they're getting the best price for their business. And often that involves organizing a sale process, scouting the market both locally, regionally, and internationally to make sure that they are partnering with the best opportunity they can find. Hence why all of this takes months. So why do it more quickly? Almost always the reason is some element of distress. So some element of financial stress in the target company, which means that if you don't do the transaction quickly, value is going to leak out of that business to the extent where it may either become insolvent or just have no real worth to an investor. Why does that happen, and why are we talking about it at the moment? Well, the obvious reason is one of the many unfortunate consequences of COVID-19 is it's put a lot of businesses under that kind of stress. Previously good businesses in certain sectors have just seen their revenue collapse for obvious reasons. If you're a restaurant and weren't able to open, hotels weren't able to take guests for a while. So those kind of shocks have put businesses under a huge amount of pressure. And whilst we are obviously seeing some recovery from COVID, those stresses may mean that a business is basically running out of cash or has run out of cash. At that point, if a business can't afford to pay its employees, for example, and it's struggling, whatever government support there might be, they might not be able to continue indefinitely. And therefore, if employees leave, if it can't serve its customers, if it can't pay its suppliers, then that business has hemorrhaged value to the extent where it may just collapse. What accelerated M&A does, fast track M&A, is try and avoid that happening by basically identifying the issues relatively early and allowing a potential purchaser to come in and deal with those issues by either investing a certain amount of cash to deal with debt situations, to deal with employee or supplier issues. But fundamentally, it's something that has to happen quickly, because if you leave it too late, it may not be worth investing in. So it tends to come at times of financial stress, the like of which we're obviously seeing globally. That's basically, in an overview, what the kind of headlines are around fast track M&A and why we're hearing a lot about it at the moment.
Thanks, Sam. That's very helpful intro, and I think we finally have the pages up on screen. Just apologies to the audience. My video is just not working. We've had some technical issues. Unfortunately, I'm having a really good hair day, so I would have really liked to show you my face this morning, but unfortunately. Just to add to that, in terms of the introduction, I'd just say that, I think it's important to remember that, I think we all are aware that we're facing sort of economic challenges today, but I think it's important to remember that, challenging economic times can present opportunities to the resourceful. For investors at this time, for the cash rich, this may be a good opportunity to evaluate and perhaps even reevaluate deals of interest which may have eluded you in the past. I think as an M&A practitioner in the region, and I think Sam will agree, the most common reason why just deals don't end up concluding in this region is just due to valuation gaps between buyers and sellers. I think given where we are in this current economic climate, it's highly possible that sellers are no longer in a position to wait for a better deal which is out there. So I think it's a good opportunity to actually seek those deals now and get possible good deals. And on the other side, just as a seller, I think this also represents a chance to finally take decisions to sell businesses or parts of your business which have historically, not quite performed to their expectations. I think historically there may have been some, degree of, uncertainty, and maybe you'd want to, delay in the hopes of an economic recovery. I think now you have some clarity. I think it's actually a time to take decisive action. So, with that as a bit of an introduction into, why we sort of look at why fast track M&A is kind of important, I think let's just dive into some of the more practical considerations of what we mean by fast track M&A. So Roshanak, if I could just hand over to you, could you just please explain to the audience, how would you typically expect traditional versus fast track M&A's deals to be structured?
Yeah, absolutely. First of all, good morning, everyone. It's really a pleasure to be here with you. I have also to say that we are all very passionate about this topic because it's been actually the type of transaction that we have been seeing so far very much in these last months, and probably what we are going to see a lot also in the next months. So what I'm gonna tell the audience about is basically all based on our live experience. So I have to say, in general terms, an M&A deal has to be structured in the same way. You have transaction documents, you have due diligence, you need to complete the transaction. What really changed? That you would normally have in a traditional M&A, as Sam was correctly introducing, need to take place much quicker. So what do we see? Generally, we see transaction documents that are negotiated on specific topics, and Stephen will give later a much focused description of what this normally looks like. What you want to do really is to be able to turn documents very quickly, because time is of essence, because most of these assets, most of these targets actually are cash thin, are considered distressed or special opportunities, because basically they cannot run as they are. So they need a buyer that is generally cash rich, that can pour cash into the company and make it run and make it survive the moment of crisis. The other element that is always essential in an M&A deal, it's the due diligence process. What we normally see are, particularly in this region, due diligence process might take a long time, particularly depending on what is the kind of target. There are targets that have not been into so much extraordinary transactions. So maybe the company itself doesn't have like this knowledge. You need to have a kind of period of training, or in any case, it requires a bit of experience. It requires very good archiving. What we have seen in this period is that, particularly given the social distancing and the difficulties to access the premises of the companies, well, if all the documents were not already in good order, would have been very difficult for the companies to be able to put together a good VDR. So what you need to do is to have a fast kind of due diligence. You need to focus your attention on specific topics and really make it a sophisticated exercise, because time is of essence. You cannot basically do the lengthy Q&A process and so on. The other element, in addition, let's say, on how you deal with the transaction documents and the due diligence process, is that you need to think through very quickly about your transition period, on how you're going to integrate this business in your group. Generally, what we have seen is that, interestingly enough, M&A transactions have continued to run, and we have continued to see new mandates, new transactions coming, because as both Ali and Sam were mentioning, these are special opportunities. Special opportunities, not just for the buyer, but also for the sellers. Sometimes people were already considering selling the target, and this basically the COVID-19 and all the pandemic and crisis has kind of accelerated that kind of decision. So what happens is basically the parties need to focus much more than they were focusing before, and make sure that the seller gets the part that is more interested in getting a good price, still a fair value market for what it's selling, and the buyer is able to evaluate well in advance what are the liabilities. Another element that is interesting maybe to mention to our audience about the difference between a distressed M&A and a traditional M&A is that most of the time what we have always considered is also a kind of, let's say, restructuring, pre-signing or pre-completion of the transaction. Well, I have to say that it's a bit difficult, consider the fact that we are talking about fast-track M&As, to do a proper restructuring. So generally what you have to do is to imagine your group to be restructured after you have completed the transaction, and to make sure that you are quick and fast into getting the target company, basically restructure it, repackage it, make sure that the cash is there, and you make it healthy. So I would say these are the main three areas that we are seeing different in a distressed M&A from a traditional M&A, that basically transaction documents need to be negotiated much faster, due diligence, you need to do it much more focused, and you need to have already a very clear idea of what is going to look like, the integration of the target in your group.
Thanks, Roshanak. I think you touched on the restructuring bit, and I think let's just explore that a little more. I think, can you just briefly introduce the concept of what we mean by, you know, a share purchase, buying a legal entity versus essentially acquiring trade and assets? How does that sort of differ?
Yeah, well, actually, I have to say this is a particularly interesting topic in UAE, because compared to the other jurisdiction where I have been working, definitely in UAE, asset deals have always been quite popular. I would say in this particular moment, buyers that are interested in buying a company more for, like, are really interested in an asset. It's a strategic acquisition. Maybe you want to acquire that particular know-how. You want to acquire that particular IP, or that company has got a real estate that you are interested in. You are interested in something very specific. And as a buyer, you don't want to buy the entire target because, of course, it's going to be full of other liabilities. It's going to have financial exposure. You don't have time even to explore it so much. So you might be more interested in having an asset deal, because basically the difference between an asset and a share deal is that by acquiring the shares, you become the owner of the company and you acquire basically the entire package. Everything that is a company, it's going to become under your supervision. You need to do a kind of fast track, but still full due diligence, because you need to know all the liabilities that are coming with by acquiring that company. While if you're doing an asset deal, well, of course, you are just targeting that specific asset. You don't care about everything that is around it. I have to say, though, that while the buyers might be still very interested in cherry picking and buying specific asset, in this moment, sellers are even less interested in assets instead of the whole company, because, of course, what you want to do is that you don't want to have the complexities of finding other buyers to buy the other assets, or in general, you just want to exit the company because it might become, it is basically a kind of liability, or you are not able to manage it. So generally speaking, sellers, of course, if even before they were more interested in having a share deal, now it's even, we see it even more. Sellers are less interested in selling single assets. What you have also to consider is that, for example, in structuring your deal as a transfer single asset, well, you have also the issue about the increasing VAT. So the same thing also applies in UAE, but of course, let's say the percentage of VAT that you're going to pay is less, so it might be less impactful from a financial standpoint. But definitely in Saudi, for example, if you're not buying an ongoing concern, might increase relevantly, let's say, your the financial cash that you need to put into the transaction in order to be able to buy the asset. The other thing is that definitely consider the whole crisis and the whole difficulties in, let's say, physical meetings, the social distancing and so on, and reaching out to people sometimes, even if I have to say internet has been very, very helpful throughout these times, is that if you are buying an asset generally, or if you are, for example, what we are seeing is material contracts being assigned, being novated, well, you need to have also the consent of the third party. So it might become more complex, because when you're doing a share transfer, the most that you can have is that contracts might contain a change of control clause. So you need to get the approval from the third party. But otherwise, you're just buying the shares and you don't need a third party to intervene in the transaction. While if you're doing an asset deal, in case the asset is not just something that the company owns 100%, but it is, for example, as I was saying before, is a contract, for example, that you want to get on behalf of the company, or maybe together with the contract, you want also to get the employees of that company that have got particular know-how, and it's going to be really helpful for your transition period and your integration. Well, transferring employees is not the easiest thing. And to be honest, consider the whole complexities, maybe sometimes share deals are easier. So I would say share deal versus asset deal has always been kind of, let's say, we have always seen these differences. In this particular time, there are things that we see more.
Yep. So Sam, based on your experience, what is the typical profile of a purchaser considering a fast-track M&A process?
I think there's two broad groups that they fall into, and I think we may see the first one increasingly in the region. You know, there are hedge funds and private equity firms in particular that specialize in distressed businesses and investment in those kind of businesses. And they have a wide skill set that allows them to do that. One of them is it depends what the thesis for why they're investing in the business is. So if you take an example, there might be a business that has underperformed, maybe through bad management, you know, variety of reasons. The market has gone against it. It finds that it's its place in the supply chain is threatened, technology may be challenging it. So that private equity firm may have a portfolio company that could bring some synergies or bring some vertical integration that works. So that's obvious. That's an obvious benefit of why they might look at a company like that. But they will also have turnaround experts. They will have a suite of people who specialize in, if they feel that the management has not been great, the kind of people who go in and can really shake a company up. So they are very skilled, many of them across the US and right across the Western markets as well, at those kind of investments, evaluating those. What they also have is, a very good understanding of how debt markets work. So, for example, what they'll sometimes do is, if there's a company that's over leveraged, they'll be well aware of that, and they might buy debt in that company. It might be a relatively small portion of debt, but it allows them a seat at the table to understand more about, from a creditor's point of view, what's going on in that company. It gives them some insight, and that may allow them to position themselves to take a much bigger stake in the company as they go forward. But ultimately, it's about what they will be skilled at is saying, here's our investment hypothesis. And that's the really important point around doing fast track and distressed M&A. You have to have a very clear investment hypothesis. You have to understand what needs to happen to make my investment worthwhile. And it's very unlikely to be as simple as, well, let's hope the markets change. That's not going to work well, because there'll be a reason why a company is in distress. And whether it's operational or financial because it's over leveraged, you've got to have a really clear plan to turn that around. We don't have a huge number of companies at the moment like that in the Middle East. And one of the reasons for that is, I think, and the guys from Clyde Co might come on to this, is around the insolvency regime, which is relatively emerging here. But again, the people in those kind of private equity firms and hedge funds will understand various insolvency regimes and why it might well be worth investing pre a company going into insolvency or out of insolvency. So that's one kind of what I'd call the financial investors. And the second is cash-rich industry players. So these will be stronger players who can see a business that's underperforming. It might be a supplier to them somewhere in there, again, in their supply chain potentially, or also a competitor, or something where they just see they can understand how to integrate that business into their business, bring some synergies, bring perhaps improved management, and they can, the problems of finance are primarily financial. It might just be a company that funded its expansion through too much debt, and now if the market's turned against it, it cannot afford to repay that debt. The company might come in and say, yeah, I can accept that debt for a lower price, and I can also fix things such that the ongoing cash flows essentially should be able to deal and repay that debt. Those are the two broad groups. What I think you don't see is people doing these things successfully very speculatively, because as I say, you have to be experienced in it, and you have to have a very clear hypothesis as to why you are doing this transaction, because inherently these deals will tend to come with greater risk than a normal M&A process. So you have to be able to evaluate that and make sure that you're comfortable you can deal with it.
Sam, just a very quick follow-up to that. I mean, turning around distressed businesses sounds like a bit of a high stakes, high reward type of game. What type of return profile would you expect in fast track distressed M&A versus traditional?
I mean, the funds will set themselves up with a relatively similar kind of return structure. But what it might be is that it's partly about the way that you value it. What you've got to look at, I think, when you're looking at this is your returns could be higher, but for each individual transaction, they will need to understand, well, what if it doesn't work out? Am I prepared to accept that? If we go into insolvency, if we essentially end up doing a sale of the assets, what's left? To Roshanak's point, if the IP is no longer worth anything, what have I really acquired here and what am I left with? Obviously, on the upside, if you can take a business and you might essentially be buying it for very little cash, but inheriting a lot of debt would be a classic example. So the check you write for the business might be close to zero, but your potential then, if you can turn that business around, is to gain higher returns. So what I would say is in a portfolio structure of a typical private equity fund, where they might do, say, 10 investments, out of a fund, then what you will tend to find with these kind of businesses that some will underperform and some will heavily outperform. But the overall intent on returns is probably fairly similar to a lot of private equity firms.
So, Stephen, what can be the impact on the transaction documents in distress scenarios, and why?
Sure, thanks, Sultan. Well, as we've heard from the previous panelists, time is of the essence, and it's the speed that has the impact on the transaction documents. This can mean a number of things. It may mean the transaction documents are less negotiated, which may mean they're less complex or maybe shorter than your traditional M&A. As Sam said before, usually you'd be looking at a window of months to negotiate and complete a transaction. On the other hand, if you have a very aggressive buyer or a fund or a VC, they may say, we have a standard suite of transaction documents, and you as the seller need to either take it or leave it. So it kind of runs from either end of the spectrum. With the need for speed, we are generally seeing that people are flexible in their approach. The buyers are realizing that there is potential opportunity in acquiring these potentially distressed companies at maybe lower than market value. And the buyers also realize, and the sellers realizing that they may not have an exit on the horizon as soon as they may like. When we get into the kind of the nuts and bolts of the transaction documents, typically you would expect that a suite of representations or warranties be given by the seller to the buyer, which is basically statements of true fact in relation to the business. Now, usually if those statements of true fact or representations don't actually materialize to be true, then there would be a claim of sorts under the transaction documents by the buyers against the sellers. Now, what we're seeing lately is a shift in that slightly, insofar as that some buyers are willing to take a risk and say, well, we appreciate that we're getting this as potentially a distressed asset. So therefore, we know that the reps and warranties that we're going to get may be more limited, and this is an opportunity for us. Again, coming back to my previous point, you may have buyers which say that, we're doing you a favor, sellers. You don't have any other opportunity to sell your business. So in that case, if you want to cash out, we need as much protection as we possibly can, which can lead to a full suite of representations or warranties. Another point that we're seeing as well, and it's probably more heavily concentrated on than previously, is a MAC clause, or a material adverse change. And basically what that means is if there is a material change on the business which is overall adverse, then there are certain things arise. So typically the buyer will want a right to walk away. In the scenario of COVID-19, the pandemic, the buyer will be saying, well, we want the ability to walk away because the whole situation is unknown to us as yet. So if something unforeseen happens within the negotiation period, well then, sorry, it wasn't on the radar, so, we need to be able to walk away. The alternative is that the seller will say, well, you know what you're getting into here. We're all pretty much aware of the impacts of this current climate and what that might mean. And usually the, I suppose, negotiated ground is something quite specific that we haven't seen before. So you would say, well, has the material adverse change impacted the target company disproportionately to, for example, its competitors in the same line of business, other people in similar business sectors, or is there a material adverse change in the context of COVID in relation to some of the key contracts, which may be a valuable part of the business? Another development that we're seeing is around purchase price mechanisms. So usually they will fall into two categories. One is a locked box, and one is which is based on completion accounts. In very simple terms, locked box is a fixed price deal. We agree a price at a particular point in time, and we will agree that there may be certain flows of funds in and out by way of permitted leakage. Now, compared with a completion accounts purchase price mechanism. It's essentially a cash-free, debt-free arrangement. And what we do is evaluate the company post-completion to say, well, what has actually changed in terms of working capital, net debt, etc. And we do a true-up, and that results in the final purchase price being paid, which of course can be adjusted up or down. With the locked box mechanism, we are seeing buyers saying, well, due to a potentially rapidly deteriorating valuation of a company in the current circumstances, we don't want that risk. So it's back to the completion accounts mechanism, which then allows for a tracking of the changes, even in a very short period in terms of fast track M&A. And interestingly, because the locked box is usually a quicker way of doing it, but because of the inherent risks around that, we are seeing a tendency towards the completion accounts mechanism. But I would say that in order to go down that route, you need to make sure that the resources are in place to actually produce those completion accounts, because it can take some time in the normal course. So just something to bear in mind in terms of practical realities. And just while I'm on the point of transaction documents, I see that a question has come in, which is basically, can we agree that M&A is not deeply and comprehensively dealt with under the UAE Commercial Companies Law? And I think that's a correct statement, and it goes to the point of transaction documents. The transaction documents will want to comprehensively set out the mechanics in terms of, for example, a share transfer, what that means, conditions precedent, conditions subsequent. The important point about the UAE Commercial Companies Law is when we get to, for example, the share transfer mechanics, because they will be very much guided by what is in the CCL.
Thanks, Stephen. That's very helpful. I think just we've touched on the idea of an accelerated due diligence process, and I think we sort of understand the reason for that. Basically, just to limit value leakage for distressed businesses. But Roshana, could you basically give a bit more meat on that subject? What do we really mean when we talk about an accelerated due diligence process? And if you are in a situation where you have to, really do a due diligence as quickly as possible, what are the key things you'd want to look at?
Yeah, absolutely, Ali. I have to say, as a legal advisor, the word due diligence always raises much attention, much fears, because you never know really how the company is going to approach this, the target company, because it really depends on how good they have been so far into putting their documents together. As I was saying before, one of the things is always like, if they have a ready archive, particularly in this period, was quite a pain. If the company didn't have the documents ready, then it's very difficult to put together a data room. But this is, let's say, the technical point. From the substantial point of view, as we have said many times during this presentation, is the fact that you need really to focus. You need to be a bit more sophisticated in the way that you look at the company. So you'd better identify those areas that are more interest to you and try to tackle the elements that might be really impactful. So it's not going to be the usual mechanical exercise of a due diligence. And this, I think, applies both to the legal and financial side. Because anyway, what you're going to look at, it's going to be mainly all those items that might raise liabilities. You want to see definitely the financing. You want to see if there has been an over leverage of the company. You want to see if the company is exposed, it has got any kind of relevant liabilities vis-a-vis third parties. You want to see, particularly under the material contracts, if the company has been providing the services that is supposed to do, if has been able to pay its employees. So, and if it has got big litigations already. So what you would normally do, and I have to say, I think when I've been doing this kind of exercise, for me was interesting to know that sometimes the list that you put together for a special opportunity distress M&A might not look very differently from a due diligence over a listed company, even if you won't expect that, because the fact is, like any listed company, generally have also a problem of limitation of disclosure of information, because there might be price sensitive elements. Maybe directors are not so happy to share all the documents of the companies and so on. So what you really need to do is to identify those areas that are more relevant, both from an operational and financial point of view to the company. So what you do is really there is one area that is like the main legal that you want to ensure that, particularly if you do a share deal, of course, that the shares are owned by those sellers, that there are no encumbrances or pledges over the shares. There are no third parties that might have any rights there. So this is basically what we normally call in technical language are the fundamental warranties. And on the other side, you want to check what are the main liabilities of the company. And I think that that's very interesting, and it connects somehow to what Sam was mentioning before, is the solvency issue. You want to make sure that the company is not insolvent, because the problem that you have, and this applies in basically all the jurisdiction, that if the company is already insolvent, and if you are buying that company, well, you need to ensure that also applies a lot in asset deals, because you are exposed to clawback, because the clawback basically entails that if an asset is sold in the previous 2 years at no fair market value, there are no reasons that basically justify the transaction main terms and conditions, particularly from financial standpoint. Well, basically, when there is a bankruptcy proceeding starting, that transaction might be clawed back, might be withdrawn, and you basically end up being a creditor in the proceeding. Of course, as I was saying, this applies more in an asset deal, because it means that the target company was distressed and has disposed of its asset in a not proper way, and that of course has got also impacts on the duties of the directors. In a share deal, it's a bit different, but still, you have to imagine that if you're buying an insolvent company, well, that company, it's basically already under the obligation of starting a bankruptcy proceeding. So you are basically already losing the control over that company. So one of the main things that you would concentrate, and I think that basically this is has got both the financial and the legal aspect into it. You want to make sure that the company has been able to pay its debts and its financial exposure in the last 3 days on a continuous basis, because otherwise the directors might be already under the obligation to declare bankruptcy. And consider that, and I think that was also a point that Sam was pointing at, that the legislation in UAE is still relatively young, because the initial law was issued by federal decree in 2016. There has been a recent amendment in 2019. Well, many sellers are worried also to try to maybe implement a preventive composition or try to restructure under bankruptcy their businesses. So actually, the distressed M&A might be a very good option, just to exit quickly the company before ending up being in bankruptcy. But you as a buyer need to check definitely that the company is not insolvent already, because that would make the scenario completely different. That's definitely one of the points that we have seen more. The other points that you need to check, of course, that are quite let's say specific to the period, are looking what are being the COVID-19 measures that the company has adopted, if the company has been able to access any of the measures that many, let's say, one of the many measures that UAE and Saudi have been trying to implement in this period in order to make the business environment more resilient, and has been definitely very helpful to many industries to keep surviving. And you want to see particularly, I would say, employment is one of those areas that people look at more, because you need to know whether the company has been able to pay its employees, there has been redundancy plans and so on. These are, of course, also elements that will clearly point at as a pre-insolvency or insolvency situation.
Can I just add to that in terms of due diligence? And I'm, by background, my main focus is financial due diligence. I think one of the things, as we say, say you have a week for due diligence. One of the advantages now is the advance of technology and the ability to extract data. So it goes back to my point around what is your thesis for your investment? Now, so it might be, for example, that you think that there's a certain area of the business that's underperforming. Say it's a restaurant group, let's say, with many outlets. And you want to get into really understanding, well, have I got a bunch of really underperforming outlets that perhaps I might need to close down that will preserve cash because they actually are losing me money? Now, the chances are in a distressed business that the information is not great. And certainly the most up-to-date information is not great, because it's likely the management team have been fighting for their lives to keep things going. So let's assume that the financial information isn't great. But what now, with the kind of advance of things like data analytics, the ability to extract raw data to test that hypothesis can actually be done relatively quickly if you've got the right expertise. And it's the same as things like benchmarking. If you believe that one of the reasons that you can improve the performance of a company is that, ultimately there are areas where costs are not optimized, where there is either too many layers of management, for example, or simply that we are negotiating good contracts, etc., etc. Again, all those things can be quite quickly benchmarked. So if you know the questions you want to answer, you can actually make a remarkable amount of progress. What you can't do is come in with what we call, and Roshan was referring, the standard due diligence. Oh, here's my information request list, and normally that will take more than a week in itself to get a response on. So you have to look at things very differently.
With the sophisticated eye, definitely.
Yeah, thank you, Sam and Roshanak. I believe we were already like at 15, but since we started like around 5 minutes late, I think we still can have 2 questions before we move to the audience questions. I'm going to take one and I'll leave Ali as well to have a question from his end. So Roshanak, I know you've covered a little bit part of the UAE legislation, but if you want to talk UAE, what does the local landscape looks like for fast-track M&As, and what can be the challenges?
This is a very interesting question, because I think we can speak about what we have seen so far, and we can try to forecast what is going to happen in the next months. I am personally very optimistic. I don't know whether this is by nature or from the experience that we have gathered so far. Particularly my experience in UAE has been very positive so far. And I have to say, despite any kind of prediction, we have been extremely busy in this period. Like, I've been number of deals being started or being kept on going, and people trying, as we were saying, to close it as quickly as possible. Not just, let's say, small size deals, but quite important deals. I think, particularly having my European background, to be honest, what I have noticed when we have sent around kind of like our knowledge, experience, fact sheets on these kind of topics, there has been a big feedback. There has been a lot of interest, particularly from European players, because I think even before, a lot of people, a lot of investors were keeping an eye on UAE. Well, actually, and this comes also from one of my conversations with one of our insurance brokers that we deal with for warranty and indemnity policies, is that a lot of people now are looking at UAE because the risks are not in any case higher than what they're seeing in Europe, but there are very good opportunities in terms of sectors. For example, technology here is growing and faster. There are a lot of interesting businesses. So what I'm saying is that there is a lot of interest. So particularly consider that, as also Sam was pointing at, a lot of, let's say, global players that usually do distressed M&A are sophisticated enough to be able to pick up things quickly, make it work, repackage it, be very operationally strategic about targets. And the interesting point is that these kind of players are looking with a lot of interest to UAE. So I believe that there is, let's say, of course, there is a bit of skepticism of certain items that are, as we were saying, due diligence process, closing deliverables, generally the pace at which we have been used to see transaction moving in this region. Also the element of uncertainties, because sometimes you start the transaction because the seller and buyer were on the same page, then they change their mind. Someone wants to be paid more. Maybe the buyer has changed his mind, then it goes on pause for a couple of months and it comes back. But in reality, what we are seeing here is that the market is adapting, because I think that everyone is now acknowledging the fact that this can be a great opportunity. Is not crises always give reason to big opportunities. It's not just, there is not just the depression or the low profile of the situation. I think the fact is, like, this is a big opportunity for companies to become more sophisticated, for the market to become more sophisticated, to realize that really it's important. In general, also saves cost and time to both the parties if they are able to implement a transaction at a faster pace. So my feeling is that we are going to see a lot of innovation. We are already seeing it with also service providers in terms of data room providers helping in like detecting quickly the information in data rooms and so on, that makes our life and the financial advisor's life easier. Also providing translation services. That's also very useful because if you have an international buyer, maybe Arabic is not their first language. So what I'm seeing is that the market is adapting. I think it's going to be a very interesting year for M&A deals. And I think that maybe this can be a very good occasion for seeing consolidation of businesses and strategic deals taking over. So I am rather optimistic, and I hope that we are going to be also part of this adventure by trying to find good solutions to new problems, let's say.
Thanks, Roshanak. Yes, absolutely. It seems optimism is the general sentiment. And I think the UAE regulation is absolutely evolving, and I think they're taking positive steps with ADGM and some other things. So just if we can, I don't think we have that much time remaining, so let's go to the audience Q&A. But one last one for Stephen, if you could just quickly just touch on, what sectors do you really expect, or have you been seeing, activity in this space within the UAE?
Sure, thanks, Ali. There's an element of these type of deals being sector agnostic, so they apply across the board, and it really depends on kind of individual targets. As we know, some companies have fared very well recently, particularly if in the tech online space, some not so well. That said, the trends that we've been seeing can be broadly broken down into maybe 3 or 4 sectors. Sam mentioned earlier on about F&B and retail. Yes, there have been some casualties in the last number of months, but we're also seeing bigger international players coming in and taking up what are good opportunities in the region. Likewise, in the education space, we have a number of ongoing interesting matters for international school operators who are looking at expanding their footprint regionally and looking at potentially some distressed schools or third level or higher level institutions because of potential underperformance and the impact that these have had, whereas the international players have the cash backing in order to invest and expand. Likewise, in the healthcare space, obviously healthcare the last couple of months has been key to getting us through all of this. However, there have been some casualties also in terms of, the ancillary healthcare, some clinics, some more cosmetic end of the market. Again, we're seeing some consolidation there, some big players taking the opportunity to pick up some assets at good prices.
I think if I might just add to that, I think for the audience, I think for the accelerated M&A, Stephen's given some really good examples there, but if you go back to education for people to understand, it's going to be that balance between, the seller. Inevitably, schools have been impacted. Certain schools have been impacted because of the nature of online learning, and frankly, some of them have had more problem collecting fees, and there's an expectation that pupil numbers in some schools will go down. So they've still got to pay teachers. The value of a school, for example, very much depends on, does it have those pupils? If it can't pay teachers, it's likely to lose teachers, and then the reputation of the school goes down. So there comes a point at which, in a way, it's good for those cash-rich groups to wait and take their time. But if they wait for too long, then the value of the school might have disappeared, because if the pupils and the parents are hearing that teachers aren't getting paid and they're seeing good teachers leave, then the pupils will leave over the summer. And, that's a big question for the sector in the region. But, that's why a bold institution who understands how to do accelerated M&A will see the opportunity, as long as the seller is also recognizing reality. That's where accelerated M&A happen. If both those conditions don't happen, then what is more likely to happen is that the school will hang on. It may be able to renegotiate with its banks if its banks are supportive, and the kind of opportunity to re-engineer and get better value for the school and ultimately probably the pupils is lost. So that's the real challenge out there.
I think I have received the Q&A. Probably it has gone privately just by mistake. It's from Mohammed Imtiaz. The question is, a company not financially distressed and operationally sound, with a balance sheet not leveraged, wants to expand due to market opportunity through an M&A transaction. Should they initiate M&A transaction now due to the time it takes to complete the transaction, or wait until the COVID-19 does clear to get a better valuation? Well, I think this is an interesting question. Really depends on the company. What I'm basically reading in this question is that the company is in a good financial position. Is definitely not, it doesn't look like a distressed M&A. It's really more kind of, let's say, traditional M&A. What we have seen also in some of the transaction, even if for much less time that I actually expected, is that sometimes people decided to put it on pause just for a moment in order to make sure that they could get the best price, or they had a lot of debate on price. So as we have also said before, price is one of the most relevant elements in a, let's say, special opportunity kind of M&A, because sometimes people address in the price many things that they would normally address under the transaction documents, that to make it faster, although they always have to bear the fact that it has to be done also at the it has to have kind of profile of a arm's length or fair market value kind of transaction. But what I would say that there is not a, how can I say, I won't have just one kind of answer. This is my personal opinion. I would say that generally strategic transactions have been going on even at this point in time without being so much impacted, financially speaking, by the COVID. A lot of buyers that are really interested in the target company, they basically proceeded and have taken the risk also of the impact of COVID-19 without much protection, because they were interested in the company. So I would say, maybe it sounds a bit a slogan, it's always a good time to start an M&A transaction, because the more time you have at disposition, the more time you can look at things with attention. So, and you are always able to negotiate. Also, I have to say, probably at this point in time, we are kind of on the exit area of the COVID-19. So we see more normality every day. Every day things are getting better. It's getting easier to complete transaction. Also, I have to say that notaries, DD, and so on have been brilliant anyway in this period. They have found like very innovation, like they have tried to find solution to each problem, and they have tried to help in any case and make transaction happening. So I would say it is better to start earlier to have conversation. Also, if you are selling, you would have more buyers. So you can count on that to get competition and get better pricing. The sooner you start, the better it is. So you will have more time to be known in the market and so on. If you are also a buyer, I think it's better to start earlier, because then maybe you can spend more time on your due diligence. It's a particular point in time. I think from September particularly, many people say the world is never going to be the same. Yeah, probably. It's never going to be the same because we have all changed. But I think a lot of things will go back to normality, and hopefully we have all learned a lot from this COVID period, and a lot of things that have now become faster, easier, quicker, smoother will stay with us. So,
and Roshnak, if I may, I was just going to add one thing to that, which is it all depends how you structure a transaction as well. So, and what I mean by that typically is earnouts. So if you're selling your business and you believe that, you know, whether it's been temporarily impacted by COVID, but you believe, you know, you are very confident in the say the medium term 3 to 5 year prospects of your business. I think at the moment you're probably not going to get full value for that because of that uncertainty, and a buyer's going to factor that in. But what that does give you the opportunity is, if you are prepared to wait and back yourself, you are likely to be able to negotiate potentially quite a favorable earnout. So i.e., if you hit what you believe will be your numbers, your targets, your profits over that period, then you may well get a very good price when that's factored in. So if you can live with that, if you want to just get all your compensation for selling your business now, then that's going to be obviously much more difficult. But if an earnout could work for you, we're seeing a lot of that at the moment.
Thank you, Sam and Roshanak. I believe given the time frame remaining, like we still have like around 7 minutes if you want to extend the session for 5 minutes. So I believe we still can go through 3 questions from the audience. I'm going to start with the one which is quite interesting because it kind of, I believe it summarizes all what you've mentioned so far on the discussion, and it applies for both DD and legal. So I'm going to address this to Ali, and probably Stephen can cover the legal perspective. So what advice would you give to an investor in a fast-track M&A scenario?
Thanks, Sultan. I think probably Clyde and Co are going to like my answer here, but I think it would be, one is to get some good legal representation. So, please feel free to share any referral fees if that buys you business. But I think really fast track and distressed M&A is quite tricky, and getting the right legal and commercial advice is just absolutely critical in those types of situations, particularly if this is potentially like the first time you're doing these types of transactions. I think the absolute worst case scenario is if you acquire a business and then day one you start getting demand notices from banks and other creditors claiming the business is indebted to them and you have no legal protection, you have no foot to stand on. I think that's just absolutely what you want to avoid. I think beyond that, another important sort of element, which I don't think we really spoke about, but is a really important part of just the overall M&A process, is stakeholder management. I think typical transactions are often between a buyer and the shareholder of a business. In a distressed M&A scenario where target businesses may have no equity, then it's effectively the banks who own the business, and then so they should be really brought on the journey early on, as opposed to at the end. So just taking that thinking a step further. I mean, if you're acquiring a financially distressed business which is really over leveraged, commercial discussions need to be had with the banks to say that this current level of debt is unsustainable. And as part of a solution to help the business survive and thrive in the future, you have to bring that level of debt down to a sustainable position. Ultimately, what you want to do is to establish a sort of partnership between yourselves as new acquirers of business and other financiers, other existing financiers, to together support the business, but also share any degree of pain. I think that's the only way a successful outcome can be achieved.
Thanks, Ali. And of course, you need very strong commercial advisors like Deloitte as well. But I think it comes back to one of Sam's points earlier. It's about striking the balance. So there's a reason why this fast track M&A is happening. So if you're the investor, you need to strike that risk between getting the deal done in a quick way so that you can get the maximum value before deterioration, but also balancing that with the risk profile, which goes back to Ali's point. You don't want to go in with no protection and go too fast. It's about saying, yes, we need an appropriate amount of legal protection, but yet we realize the end goal is the acquisition of an asset, which is not going to be perfect, but we'll try and make it as good as we can in terms of protection and also getting the best value.
If I may add also to that, I think one of the instruments that we are seeing, definitely that ties up to what Stephen was just saying, is that you try to protect yourself under the transaction document and under your, let's say, legal arrangement. A new instrument that we are seeing used more and more in this region is the warranty and indemnity policy. So basically, you get an insurer that covers the seller's warranties. And enough, because I think it's relatively a young instrument in the region, but there are more and more, and insurers primary, let's say, that are looking at this region and they're willing to cover for M&A transactions with warranty and indemnity insurance policy. And when I had this discussion with one of the insurance brokers, that I was like, how come you think that this is going to grow and grow? Because we have always thought that there was less possibility to get a warranty and indemnity policy in this region, given the due diligence process, the fact that global insurers look at the data room and the information and so on. They might say, no, there is too much risk here and so on. What I've been told, and that is again adds to the optimism, let's say, is compared to other jurisdictions, the risk doesn't seem to be materially more, and in turn, basically, it is very profitable. So clearly, probably it's also a matter of raising breaches or warranties, or getting either enforcing the warranty and indemnity policy that they see less happening in this region, or more probably it happens, but generally speaking, for the premium paid, they get a good amount of money anyway, even if they're exposed from a risk point of view. And I think it's a very interesting instrument, particularly because more and more insurers are happy to do a so-called synthetic warranty and indemnity policy, which means that it's even independent from the warranties that the seller has been granting under the SPA. So again, as we were saying, there are new instruments coming in this region. There are new tools, new supports, and hopefully it will all help to make the business successful.
Okay, so I'm gonna have the second question, and I'll end with the last one shortly right after that. But please, if you can have, like, for the last two questions, if you can have quick answers given the time frame. So I believe this as well applies for both Clyde and Deloitte. So that's from Dr. Youssef. As you know, the genuine asset of any organization is people. So what is the impact of individual performance due to the fast track? Like, this could have different aspects. I don't know if you've got it. Like, for me, it was a bit it was a bit unclear, the first part of the question, and the last part is, if there will be a merger process, how it will how to make it successful.
Sultan, if I could just jump in on the people answer, I think it's actually a very important question. Dealing with distressed M&A scenarios, and I think this is why we touched on accelerated due diligence process, because if you're talking about a distressed business undergoing a transaction and things just take too long and people start to feel at risk and then key people start to leave the business, then you end up in a very bad scenario where a business which is already in trouble starts to lose people, so you start to lose equity value. So I think that's kind of why we've been saying you have to accelerate the process to make sure your key people feel confident that they're going to get their next paycheck, that they're going to stay around, and the business has an opportunity to survive and thrive, or else you're just going to get people jumping ship, which is not good for anyone.
And just to add to that, I think that in a traditional M&A scenario, you will generally have a bigger team from the target company involved, which means that people find out about this deal because they're usually actually kept quite confidential. If you've got a small deal team and you're doing a fast track M&A, you contain the information. And then the positive outcome of that for employees is saying, yes, we went through a difficult time. However, we have been working on this in the background, and we're very glad to say that now we have a new buyer, a new investor, etc., which goes back to Ali's point about, I'm the employee, I want to feel secure, and I want to know where my next paycheck is coming from. In terms of making the merger process successful, that's where you have to rely on your senior management, because ultimately it will be one culture potentially versus another, and it's about the human interaction and making people feel part of a new or changed team and embracing change and encouraging them to embrace change.
Thank you, Stephen and Ali. And the last question, I believe Sam can cover this. So it's, Sam, in a fast-track M&A scenario, what would you consider the key risks to focus on to mitigate? And, sorry, what is a reasonable amount of time to complete an accelerated due diligence process?
Well, I'll take the second one first because it's the easier one. I mean, as I said, when we started this, I was saying that your typical M&A process will certainly last a number of months. By accelerated M&A, I think ultimately we mean weeks. You think of it in terms of weeks, and in some cases in days, which is much more common where it's interlinked with an insolvency process and is what we might call a pre-pack process. But it is that, and that gives the context to the first question around what to focus on. And I'll just go back to my point. You can't decide what to focus on once you're in the process. And to Stephen's point about senior management, you need to, once you get into this, which might come quite quickly, but you have to be committed. You have to want it to work subject to certain non-negotiable risks. Because if you haven't, say, as an investment team, say you're a company, if you haven't got your CEO and your board of directors in line with you before you start the process, you may not have time to go through that if people start throwing questions in. So to make it work, you have to be in the same direction. You have to have advisors on board, I think, because again, typically we understand that people often want to do diligence in a phased manner to preserve cost. It's perfectly reasonable. They might want a high level red flag diligence just to say, does this kind of work? And then we move on. You really haven't got time for that. So you have to go in full. That would be my thing. And then the risks will be dependent on the company, what your investment thesis is, and the deal structure. So we talked again about, if you are just buying assets and taking people, that de-risks it. But it will vary case by case. But what you have to know in your mind before you start is, what are the key risks that I'm really concerned about, and then test against those.
Okay. I don't know, I've lost you, Sam, for the last minute or so. I believe you're done with your answer, right?
Yes, sorry.
Yeah, thank you. So any last words from your end before I close and refer to next week's session?
I mean, from the Deloitte end, I think it's just to say thanks again for the opportunity and the discussion. Hopefully, we've helped people sort of slightly demystify this fast track M&A and to understand why we think we'll see more of it, and hopefully some of the things that it's going to take to be a successful participant in a fast track M&A, because I think it's going to be important and it's going to be good for the business community if more of these transactions can be done to salvage struggling businesses.
Thanks, Sam. And maybe if I can just add that, yeah, I'd echo exactly what Sam is saying. You know, you do need to get advisors involved, particularly in these types of transactions. And people like Deloitte and ourselves are used to this, but also we understand the regional challenges. And if you're talking about completing a transaction in a matter of days, sometimes that just isn't possible, but we know how to navigate these challenges. So obviously, if anyone of the participants wants to have a conversation or needs any assistance, I'm sure I'll speak on behalf of all the panelists to say that we'll be more than happy to support and assist.
I want to thank you all for this interesting session, for all your insights. This is a very interesting topic, as mentioned in the earlier, that many organizations probably going to go through M&A, at least if not fast-track M&A in the coming period, but now we're focusing on the fast-track M&A. So thanks for your time, Sam, Ali, Roshanak, and Stephen. And thanks for all the audience for staying with us till the end of the session. We had a couple of technical issues. We're 10 minutes late, but that's fine. This is probably the second time we had it on the last 8 weeks on 16 sessions. So I want to wish you all a happy Eid and hope you enjoy a good staycation, I would say. I just want to let all know that post-Eid during September for the last 7 sessions, the timing of Chamber Talk going to be from 5 to 6 instead of 11:30 to 12:30. And the first session after Eid going to be on Tuesday with EY on ensuring resilience as we plan for the future, workforce planning, and fund optimization. Thank you again for your time and wish you a good day. Cheers.
Thanks for your time. Bye-bye.
Thanks a lot.
Thank you. Thank you. Bye.
Thank you.
Cheers.